Private equity was thought of as an experiment 30 years ago. Now the sector holds over $4.5 trillion in assets. We will explore the evolution and massive growth of private equity. Plus, if you wonder why mutual funds pay capital gain dividends and what this means for your wallet, we have the answers. This is 7-Day Yield. Welcome to 7-Day Yield. I'm Mitch Rochelle.
And I'm Haley Zimring, and here's what's trending. According to a new PwC study, small business employees feel more appreciated at work than employees who work for larger organizations. And the numbers are staggering. 43% of workers at small businesses say they feel happy at work versus only 27% of their peers at larger companies. So why the discrepancy? The study says smaller companies appear to have less bureaucracy, tighter cultures, and more leniency around work policies, including flexible hours and the ability to work from home. Our next trend bodes well for employees working from home because consumers today are said to be dining out less and cooking in more. According to a new report from research firm NPD, fast food restaurant visits have stalled in the past 3 months, and fast casual restaurants have declined for the first time since 2004. Coinciding with this news is the fact that grocery prices have declined 5 out of the past 7 months, making the gap between restaurant prices and grocery store prices the largest spread since the mid-1980s. Our final trend hones in on the world of ETFs and mutual funds because when it comes to investing money and growing wealth, mutual funds and ETFs have always been a popular way to go. And in fact, a PwC study shows that the ETF market has more than doubled in value since the end of 2009. 2015, roughly $150 billion flowed out of mutual funds, while ETFs saw $150 billion in inflows. So Mitch, why is this happening?
So there's 3 things: flexibility, transparency, and tax efficiency. That all of the money that's flowing out, almost dollar for dollar, flowing out of mutual funds is flown into ETFs for those primary reasons.
Interesting.
So speaking of tax efficiency, on 7-Day Yield, we spent a lot of time talking about the differences between mutual funds and ETFs. However, the tax consequences can be a little tricky. I got a download on taxes from PwC partner Karen Visco. Take a listen. So Karen, I get my 1099, I'm getting ready to do my taxes, and I notice capital gain distributions. What is a capital gain distribution to a mutual fund shareholder?
Well, when a mutual fund sells securities that it holds that have appreciated in value, it will recognize capital gains. And it may sell those securities for a variety of reasons. It could be a strategic move by a portfolio manager. In the ETF context, if the fund is tracking an index, it may need to rebalance its portfolio to maintain the index tracking, or it could be done to generate cash to meet shareholder redemptions. So when the fund generates these capital gains, it then distributes those to its shareholders, and that's what you're seeing on your 1099.
So it's a dividend that I get where I get cash back, and I may or may not reinvest it, but it's characterized as capital gain?
Yes, so mutual funds and ETFs have the ability to flow through that capital gain treatment to its investors. So those capital gains that are generated from sales of securities that are held for longer than 1 year are what you're seeing as capital gain dividends, and those will be taxed to you at a lower rate than an ordinary income dividend would be.
Do mutual funds also pay out ordinary income dividends as well?
Yes, so to the extent a mutual fund earns interest income, dividends, or short-term capital gains on securities held less than 1 year, they would pay those to you as ordinary income dividends, which are taxed at a higher rate. Currently, the rate is 39.6% for our highest earners.
Got it. So you mentioned ETFs earlier. Are ETFs different than traditional mutual funds in terms of these capital gain distributions and the way they pay out to shareholders?
Yes, they are. So ETFs tend to be much more tax efficient because they pay significantly less and fewer capital gain dividends. And that's really due to the strategy and structure of how an ETF operates. So ETFs track indices. So they tend to have much more static portfolios and less transactions that would potentially generate capital gains. So they're generating less capital gains based on their transactions, and then also the way shareholders can redeem from an ETF, they typically will redeem in kind, meaning that they will redeem securities instead of cash. So the ETF would not have to sell shares of the securities that it holds to generate cash. They would just distribute those shares to a shareholder, and that event is non-taxable to the ETF, therefore generating significantly less capital gains. And we see in ETF complexes, very large complexes of 100 plus funds, maybe only a handful of them may make capital gain distributions in a given year.
Got it. So if I'm getting my 1099, I'm an ETF shareholder, I won't have as much noise in my 1099 as if I had mutual funds. One last thing before we go, target date funds. What are target date funds, and are those any different from a tax efficiency perspective?
Well, so target date funds tend to focus on a specific mix of assets. So it could be bonds, equities, cash equivalent investments, and that mix of assets is really structured based on a point in time, so potentially a retirement date. So for example, if you're a younger worker and you think you may retire in 2050, you would invest in a target date fund with the date 2050. If you are a worker that may retire within the next 10 years, say 2025, you would invest in the 2025 fund. And the balance of assets in those funds will be targeted to give you the types of returns that you're looking for based on your retirement date. So the 2050 fund, since it has a longer runway, may have more investments in equities because you have more room for more volatile investments or more risk. Whereas the 2025 fund will be more focused on fixed income and cash equivalent investments, which will have a more current income stream and less risk in the equity market.
So take some of the thinking out of it for you.
That's right.
So Gary Melcher joins us now. Gary, what exactly does a target date fund invest in?
I think as Karen said, the funds themselves are set up, they have a specific target that's tied to an objective, right? It's either going to be education purposes or retirement generally. So what you're doing is targeting an event that's going to occur, and you're going to then need that investment, and that investment proceeds at that point in time. The portfolios will change, they'll be rebalanced over time. As you get closer to the period of time when you need to use that investment, they'll probably be going more towards fixed income and investments that are generating cash, probably more aligned towards equities earlier in the time frame of that target date vehicle.
And are you putting all your eggs in one basket when you invest in a target date fund, or is it diversified?
No, they're definitely diversified. And as I said, they're going to be diversified based upon kind of where you are, in the overall spectrum of the ultimate investment need.
So Gary, before you go, the set it and forget it mentality, is that really what the target date fund was designed for?
I think they've become very popular because, again, you're going toward a particular goal. Okay, it takes a little bit of the objectivity, kind of off, or subjectivity really off of the table, and saying, listen, my objective here is that I need to go toward a particular goal, help me get there, rather than managing the investments outside of the fund. The fund itself is structured to achieve that particular objective at the end of the time frame.
Great. I think we have more of you later in the show.
Great.
When we come back, we're going to be diving deep into the world of private equity. Stay with us.
You just got a big bump in miles, so this is a great opportunity for an upgrade. Sound good? Great. Because you're not you, you're a whole airline. And it's not a ticket you're upgrading, it's your entire operations, from domestic to international. Which means you need help from a whole team of advisors, from workforce strategies to tech solutions and 1,000 other things. So you call PwC, the right people to get the extraordinary done.
Welcome back to 7-Day Yield. I'm Haley Zimring. Some 30 years ago, what we call private equity today was a new concept. Fast forward 3 decades, and the industry has over $4.5 trillion under management. 7-Day Yield contributor Nidhi Sinha recently spoke with retired PwC partner Ray Beier, who explained the growth trajectory of private equity.
You've seen in sort of the 30 years that you've been at PwC, private equity go from the experiment that it was to what it is currently now. Tell me a little bit about the evolution. How did you see things change over the last couple of decades?
During the early stages of private equity, it was all about buying companies. Financial engineering would drive returns, and that was through the 80s and perhaps the early 90s. And then those financially engineered deals, pricing of businesses became more consistent, I would say, and financial engineering was no longer became a tool to drive returns on investment. Today, if a private equity firm does not have significant, deep operational capability, they will not be in business. So we used to think of private equity simply as a private equity firm. I think the large private equity firms today, when you look at them, they have expanded into multiple asset classes. So they all have their buyout business, which I'll describe as buying companies and then selling them. And they've expanded their investment prowess to other asset classes that are considered alternatives: real estate, hedge fund world, and credit. And so today, the largest private equity firms actually are multi-dimensioned alternative asset managers.
And do you think that's sort of the wave of the future? Like, what is the future of the industry?
I think you're going to see continued growth. You're going to see them becoming more. You're going to see them become bigger financial institutions. Candidly, I think of the biggest ones not as private equity firms, but as financial institutions.
I've heard you talk about private equity being a permanent fixture in capital markets. And obviously, public equity is vibrant. So how do you think these two coexist with each other?
It seems to me that the key value that the existence of private equity markets bring to the overall marketplace is that it gives companies a chance to remake or refine or transform themselves in a private context. In other words, the public scrutiny that occurs with many public companies, it perhaps becomes very hard for management teams to remake a business. And part of that is perhaps driven by investors in the public markets maybe asking for short-term results. And when you take a company out of or an asset out of the public markets and you put them into the private markets, a much smaller audience of people is looking at the asset, is looking at the performance of the asset. And in fact, the ones that are looking at the asset are either the management team or a small number of owners. And then as that asset transforms itself, it very well may be ready to be sold to the broader marketplace, the public marketplace. That's how I think of it, and I think there are a number of examples where that storyline is held true in today's marketplace.
So Gary's back with us now. Gary, as Ray discussed, private equity has become a very permanent part of the capital structure. How are private and public markets able to coexist?
I think one of the things that Ray touched upon, which is critical, is kind of the stage of development, right? Earlier stage enterprises are accessing the private capital markets and are able to access that more easily. There's a smaller investor base. Institutional investors are clearly looking for opportunities, and they've been a very significant source of capital for those private investments. When you look at private equity investing, there's kind of three components of it. One is the companies, the private companies that investors are investing in. Second would be private equity funds that have come to bear that the asset managers are sponsoring, which gives you a broader investor base. And the third would be a number of asset managers that are private equity investors have gone public. And those companies, so you can buy the stocks of a number of private equity firms, which then gives you access to the capital markets in a public forum. So it's very interesting as you're kind of accessing that aspect of the market. But to your point, there's absolutely coexistence based upon what the needs are.
So Gary, the key word in private equity is private. And is it a challenge as more and more focus on transparency in capital markets becomes the issue? A private equity firm is going to be able to continue to sort of be private?
So I think they are. I think the expectations of their investors, no matter how you kind of look at that three-tiered structure I just went through, are looking for information, are looking for transparency. I think that the firms themselves are investing in, whether it's technology, systems, people, controls, what have you, so they can provide more information and be more transparent to their investors. That's an expectation. As I said before, institutional investors and asset owners are critical to them, and those types of entities are looking for information and require transparency.
Great insights, Gary. On our next show, the new Department of Labor fiduciary rule is over 1,000 pages long, and we're going to break it down for you in 5 minutes or less.
Thanks for watching. We'll see you next time on 7-Day Yield.